all-time highs. I'm going to bring in Main Street Asset Management CFO Aaron Gibbs, along with Slate Stone Wealth Chief Market Strategist Kenny Paul-Kari. Kenny, it feels like Meta is sort of that proxy for the oversold stock, right? I mean, it's a great reaction. It's up big, but then if you pull up a 6-month chart, you're hoping that you're at least 30 years old, maybe you'll break even.
No, I think you're right. For today, that's exactly what it feels like it's doing, right? It's kind of rescuing the market. I think it's short-lived. I think just because the market, especially the tech names, have more to go on the downside, because I think the Fed, unlike what Brian Belski said, and I love Brian, I think he's a great guy, but I'm on the opposite camp as him. I think that inflation is not going to roll over. I think the Fed's backed into a corner, and they're going to have to get more aggressive, and that's going to continue to put pressure on those names specifically, right? They've already done it, but it will continue to hold those names down.
Well, but let's throw a wild card in there for a moment, Aaron. This GDP report, in the sense that it was weighed down by inventories were almost 6% of the fourth quarter GDP, which was fine. Everyone took the victory lap in the data, kind of playing it off. Could we have so much inventory with a slowing economy, high prices, that actually becomes a problem?
I think it could, but I think another thing that we can look at is this is a contraction. And we've been talking about recession. A recession is defined as 2 quarters of contracting GDP. And
everyone have modeled saying, hey, that can't happen because the first and second quarter are going to be positive.
Right, and it won't happen for another 12 months. So now, if we have another contraction in the second quarter, with it, depending on how we go, and right now it does not look like we've got inflation under control, this could be the beginning of that recession. Now, let's hope we knock it out, and by June we're out of that recession and back to normal.
Like going to the dentist. Yeah, okay.
But I think this is actually something important, that this negative is the first sign of a recession.
Kenny?
It was funny because Brian said he didn't see the recession coming, not yet. It will come, though. That was very interesting how he said it, because when will it come? I think it's going to come towards the end of this year, very early next year. It's interesting because I'm curious what he meant by that.
Let's talk about then. So obviously you don't like tech. You brilliantly moved into value. But now, and listen, I'm trying to help the audience here, because a lot of people say barbell, quality, value. Nobody knows what the hell that means.
Right.
All right. Let's I'm pulling up a chart of traditional value stocks. Clorox, Heinz, and Philip Morris, right?
Right.
Know what their PE ratios are? 74, 53, and 41.
Are those current?
These are current as of this morning. Okay, I'm going to pull up traditional growth stocks that people should not be in. Their PE ratios: Facebook 13, Netflix 17, Google 21. Where's the real value here? What's really, honestly, do you chase a Clorox here, or do you buy a Google?
Well, it's very interesting, because the tech names are going to get to a point where they become value, for sure. I just don't think we're there yet. And listen, value could continue to go higher, especially if we have this inflationary environment, which I don't think is going to settle down. I think the money will still pour into value.
Yeah, and let's not forget, a lot of those names are companies that can increase their prices very easily with inflation.
Right.
But on a broad basis market, because those are extremes, growth is still trading at a 40% premium to value stocks, and that is high.
Don't you have to jump in there, though? Don't you have to dive in? Because this includes, you would include a name like a Google, but you may have a Peloton in there. I mean, isn't it time to break all of this up and say there's some serious opportunities here for longer-term investors, someone who's not looking to day trade?
Yeah, and it doesn't even have to be even so stock-specific. You can even break it just through the sectors. There's so much diversification and dispersion across different sectors and industries that, there's some big differences and jumps when you blend it into the averages.
Kenny?
No, I absolutely agree with that. I think you have to be stock specific and not just industry, just ETF agnostic.
Are you buying anything here?
So I am, but I continue to be in the value names, right? Okay. So I'm buying more consumer staples. I'm buying financials. They're down, but I think financials are going to do well.
What happened to financials? It was supposed to be the Finergy year. Energy did its part. Finergy fell off the map.
I don't know why financials fell off the map as much as they've done, but I think that's actually an opportunity in the financials. I think they're going to turn right around.
What do you like, Aaron?
I'm also looking at financials, and just they are at such a low spot. The yield curve is sharpening, so in theory they should be doing better going forward.
In theory, though, the yield curve went through the moon and it went down.
It is
Isn't that a red flag?
Yeah. So I think it's really.
Are you the matador or the bull here? I mean, this is a red flag. Which one are you? because you're like, yeah, it didn't work, but let's double down.
No, I think
I'm
look,
busting your chops. I hear what you're saying. So stick with the financials.
I stick with the financials. There are some of those safety bets, but also, again, I am trading like crazy. I'm totally, if you're getting into anything, I put stop losses on anything. It's very disciplined because this market has been unpredictable.
It has to be. You have to tighten up your stop losses.
I agree.
Yeah.
Thanks so much. I love our conversations. Talk to you both real soon.